I don't see the case for rate cuts in this data. I mean, just in order of importance for what I'm looking at initial claims dropping back below 210,000 in the latest week. I mean, exceptionally low layoff activity. So that's the sign of, I think, a still solid labor market. And then if you go next to PPI, it definitely came in hotter than we expected. We already penciled in a 0.3 core PCE increase for February, so for later this month. So we might have to take another look at this after this broadcast and maybe bump that up a little. But nothing there that I think, if I'm a policymaker sitting around Washington next week, I'm going to be really confident that we've done enough. And then the retail sales. I mean, I think Tom is exactly right. Look at core. Look at the control group. The only thing that we always tell clients about retail sales is it's just capturing a subset of consumer spending, mostly on goods. I like to look at, consumer incomes still growing at a good pace through February. And I think that will go into spending. Right. So that's my take.
Jeffrey Cleveland with us at Payden Rygel. We welcome all of you across America and worldwide. Thrilled with the worldwide performance. Apple CarPlay is the way to get us. It's a new way to get us. Safer, better. Good morning on Android and Google Play as well. On YouTube, go to Bloomberg Podcasts. And it's just growing. Thank you for your interest in Bloomberg Podcasts and our live chat out there, really informed. Good morning. Of all places, Caracas, Venezuela. Thank you so much for coming to us from Caracas this morning. Jeff, Jason Furman up at Harvard had a really important, and I want to sum up the economic data here, but he had a really important insight, which is 3.9% unemployment is different than 4.0% unemployment. When I see claims and what they did today, 209,000 with a constructive fully employed revision from 217 to 210, you don't get to a 4% unemployment rate, do you?
No, and you also have continuing claims dipping back below that 1.9, so that looks good. I'm a little skeptical on the 3.9, Tom, that we got last week. I mean, you look at that household survey, that is notoriously volatile survey. I think the confidence interval, the plus minus, is 600,000 on the household employment survey. It was down a bit last month, but it's been volatile in the last year and a half. And it's possible we touch 3.9, but then we see a dip back down in the unemployment rate in the months ahead, back to 3.7 or something. So I think we're going to stick under 4% for the year. That's our forecast.
So the labor market, it is still hot, of course. Like you said at the top, you don't see any reason for the Fed to cut rates here. Let's try to create a little bit more controversy. Do you put any water in the theory that maybe actually the next move will be a hike?
I think you can't rule it out. Why do I say that? It's possible to be controversial that maybe we're just going to settle in at a bit higher year-on-year rate of inflation. Not 5%. Not 6% like we saw in the middle of 22, but 3 to 4%, something in that range. And then our policymakers going to be okay with that. Maybe some are. Maybe some think that the inflation target should be higher. But I think by and large, most policymakers want a 2 handle on inflation. So 3 to 4% on core inflation is too high. And in that case, if we just sort of linger there, that might open the door to another hike. In our outlook, we put about a 10% chance on that for the year. So, it's a risk. It's not our base case, but it is definitely a risk.
Katie, 2-year yield up 1 basis point, 10-year yield up 3 basis points this morning.
Yeah, we are seeing a little bit of a cooling of that knee-jerk reaction. You take a look at S&P 500 futures. They're still higher to the tune of 0.2%. They had been looking at a little pre-market gain of 0.3%, so not too much action. But let's keep this conversation going on inflation, that sticky inflation. What keeps inflation elevated, maybe to the tune of 3 to 4% when you really break apart the components?
When you break apart the components, we benefited last year from goods prices decelerating quite a bit, falling year on year. It's possible in our view that's behind us and goods prices will be sort of flat. There could be even some upside pressure there. So I wouldn't bake in any further disinflation based on that. Another area where I have a keen interest in, people say to me, look, Jeffrey, look at the private sector rent metrics. They're showing disinflation. And I say, yeah, a lot of those private sector rent metrics are looking at new leases. So that's only capturing a subset of the market. The BLS metric that's looking at the average rental rate, including people who have renewed leases, that might be a better reflection. And 5% rental increase, that might be a better reflection of reality. That's higher than we saw pre-COVID. So that argues for higher inflation, core inflation going forward.